There's a vast range of products available to investors. Many investors are happy with mutual funds or ETFs, exchange-traded funds. Often these passively follow an index or invest in a diversified portfolio of similar assets. The most common ones are bond and equity index funds and ETFs. Some investors like to have more control over their assets, so they buy individual bonds or equities. If you're familiar with the investments we just described, and if you have experience investing in them, then you know that they have some characteristics that make them attractive and others that cause us to hesitate to invest in them or to limit the amount of our wealth we're willing to commit. We may be lucky enough to sell a bond for a profit, but bond investors primarily expect to get the returns from interest. Equities sometimes pay dividends, but price increases is the main way in which we hope to profit from an investment in equities, precious metals, or mutual funds and ETFs. For all of these investments, there's the darker side of risk. The issuer of a bond might default, a company might go out of business. These are credit risks. But interest rates might rise and equity markets might fall. These are market risks. Nearly every investment has some of each of these. Additional risks include liquidity. It might be difficult to sell an investment when we want to because there's not much trading in it. Likewise, there may be a wide bid-offer spread in the market so that you need to pay more when you buy and receive less when you sell. Until you're comfortable with these ideas, have experience with these simple investments, you probably should not participate in structured product investments. This is because the pricing and risk characteristics of structured products are not as obvious or as easily understood. Assuming you're still with us, let's look at a structured product. We just made this one up to show how they work. All the names and investments are fictional, so don't try to go out and buy them. The issuer of our structured product is going to be Bob's Bank of Brooklyn, Triple B Bank. The broker who will sell the investment is Big Asset Manager, BAM. The underlying investment is a high-yield index called HYI. HYI is an equally weighted portfolio of 20 U.S. equities. Each equity is chosen for its high dividend yield. The portfolio is rebalanced every 6 months based on the market prices of the equities, so that at the beginning of each 6-month period, all the equities have the same share in the basket. Our structured product is called an HYI Performance Note. The price will be $100 per unit. Maturity will be in 5 years. The payoff to the note will be the increase in the value of HYI over the 5-year period. This note has some protection. If HYI has not gone up at the end of the 5 years, the investor gets the original investment back. There's a coupon. Every 6 months, the investor will receive a payment of 1.5%. So, would you like to invest in this product? Well, what are the possibilities? Suppose that after 5 years, HYI has gone up 25%. Then you would get 125 for your original 100 investment. You will also receive as a payment 1.5% every 6 months for 5 years. So this is a total additional payment of 15%. What if the HYI index has gone down instead? Then you'll still get the 15% coupon payments and you get your original 100 back. Before we say anything more, let's compare this product to a similar ordinary investment. You could have just bought the stocks in HYI yourself. Let's assume there's an ETF based on this index. That is an exchange-traded fund that holds the same shares but trades like a single share. The payout at the end of the 5 years would be the same as the structured product if HYI goes up over that period of time. But if the index goes down, the ETF loses value while the structured product does not. That sounds good, but there's some differences. These differences are not so obvious to investors, but they are what drives the product. First, the product does not trade on an exchange. It's intended to be held to maturity. If the investor wants to sell it before the 5 years are up, the investor will have to go back to the broker, BAM, and ask for a price. Second, if the investor owned the ETF, the payouts over time would be the actual dividends paid by the shares in the basket. This might well be, and very likely is, expected to be more than the 1.5% paid by the product every 6 months. Third, the investor is actually lending money to BBB, to Bob's Bank of Brooklyn. It's easy to see this. On day one, the investor hands over 100, which goes to BBB. After 5 years, the investor does not get actual shares, but they get a payment from BBB. So the investor in the structured product is lending money to Bob's Bank of Brooklyn. They're getting exposure to HYI. They're giving up the dividends on HYI, but getting coupons of 1.5% every 6 months. The investor is also buying a put on HYI. This is a derivative product that pays the difference between 100 and the decrease in HYI if the price of HYI is lower after 5 years. How can an investor tell if a structured product is a good deal? That's a long story, and this was just the introduction.